Hello, everyone, and welcome to today's webinar. Our topic today is Semiconductor Value Chain Explained. The next slide, please. My name is Maud Stulling. I'm working as a public equities portfolio manager at PICT Asset Management in Zurich. Please bear in mind this session will be recorded. Your feedback is very valuable to us, so please fill out the survey and also please use the Q&A tab for questions. Today, our guest is John. One back, please. Our guest today is Jonathan Bathgate, investor at NZS Capital. I can highly recommend checking out the homepage. There are lots of articles, white papers, and also a very good newsletter that you can sign up to. It goes beyond the whole semiconductor discussion that we have today, so highly recommend it to sign up. The next slide, please. We do have some upcoming events. So as you can see here, we have some networking drinks coming up before the holiday season in Bern, Zurich, Geneva, or Lugano. Please have a look at the homepage. Tomorrow, I will be hosting a webinar during lunchtime, European time, capital returns, investing through the capital cycle. Please have a look at this one in case you're interested. And then in December, we have another session, Women in Finance. And this session is sponsored by Vanguard, our sponsor. We appreciate their support very much, so we can offer these high quality webinars for you without fee. With that, I hand it over to John. Thank you so much for joining me today, John.
Hi, Moritz. Thanks for having me. Opportunity to talk to everyone today. Let me share my screen really quickly, and we can get started. Can you see that okay?
We can, yeah, perfect.
Great. Yeah, well, thanks for having me. We've got a lot to cover. One of the most complex industries in the world, so maybe 45 minutes won't give it justice, but we can get through as much of this as we can. So just a quick background on myself and on NZS Capital. So NZS is a Denver, Colorado-based employee-owned boutique. We manage strategies that are global growth and global technology focused. Our team came from Janus Henderson. I spent 12 years at Janus Henderson before joining NZS 4 years ago. So I've been in the industry for 16 years now, and the very vast majority of that has been spent researching the semiconductor space. We manage about $2 billion across primarily institutional clients. We do have pooled vehicles in the US and in Europe as well. And then so NZS, the term for the founding name of our firm, NZS stands for non-zero sumness, or it's the game theory term for win-win outcomes or creating kind of value for everyone in your ecosystem. And I think that the semiconductor industry is really a great example of this idea of non-zero sumness or win-win outcomes, because the companies that have been successful are really the companies that have created a lot of value for the whole ecosystem, not just trying to grab every dollar for themselves. And we can kind of get into that as we get into the slide deck here. So just a quick agenda. I'll go through just kind of why I think semis are interesting and why we're here. We'll spend a lot of time going through the value chain and just walking through the industry at a high level. And then geopolitics are very central to what's going on in the chip industry these days. So that's an important topic. And then lastly, if we have time, we can go through artificial intelligence. And I think that the rise of NVIDIA and having a $1 trillion semiconductor company, I think is pretty special. And so we can talk about kind of how we got here in terms of AI. So just to start out, so why semis? Why are we here? I mean, my view of the semiconductor industry is that semis are the building blocks of the digital economy. And I think most of the economy is moving digital. Things are being run more on software. Every company is trying to be a technology company, whether you're a healthcare company, agriculture company, appliances. And what's pretty clear is during the pandemic, we learned that the world runs on chips, and we had shortages that were highly publicized that I don't need to describe for anyone. It was highly disruptive to the automotive industry, but it was disruptive in healthcare. It was disruptive, and you literally can't buy a refrigerator without chips these days. And now you're seeing it in the investment in artificial intelligence. We've got shortages of chips of GPUs, and so that's obviously made chips, I think, just top of mind for everyone, for governments, for their customers. The relationships between suppliers and between chip suppliers and their buyers is changing, and I think everyone's kind of woken up to the fact that the world runs on chips. You know, another important point about why the industry is relevant is if we're going to decarbonize as a society, we really cannot do that without semiconductors. Like if you look at traditional methods of power generation like coal or natural gas, that is very little chip content versus, you know, solar arrays and wind turbines are very highly digitized. There's a lot of power management. There's a lot of current that needs to be converted. And so that requires a lot of semiconductors. So this is a slide from onsemi, which is a key supplier of some of these, you know, renewable energy applications and also, I mean, energy storage. And similarly, you know, if the transportation fleet is going to go electric, this is a slide from Infineon in Germany. So the left side of this chart is, you know, a normal internal combustion engine driven vehicle has, you know, $700 worth of chip content, give or take. And if you make that a battery, an EV, then that content almost doubles. And that's because, you know, when you put a big battery, that's basically a bunch of laptop batteries strung together in a car, you need very sophisticated power management, you need battery management systems. The charging itself requires a lot of semiconductors, and charging stations have actually several $1,000s of chip content. And so I think just in terms of looking into the future, you know, semiconductors are kind of key facilitators of some of the most important transitions we're going to make as a society. And lastly, just, you know, as investors, it's important to think about, I mean, semiconductors have been a tremendous driver of returns for investors over the last 10 years. So this chart is the, you know, the SOX index, the semiconductor index relative to the NASDAQ or the S&P or the ACWI. And it's obviously just trounced, you know, any index over the last 10 years. And so I actually thought this was an interesting exercise. I looked at the top stocks in the ACWI over the last 10 years. And it makes sense. I mean, I think when people think that semiconductors have done well, there's some of the household names like NVIDIA has been the very best stock in the world over the last 10 years. And AMD is very visible, but also some of these key, you know, facilitators of the ecosystem like Cadence Design Systems and Synopsys, or the equipment players like Lam Research and Tokyo Electron have also been really strong performers. And many of them have, you know, more than 10x their stock price or more over the last, you know, over the last 10 years. And so all these companies are in the top 15 performers in the ACWI over the last decade, and they're all from the semiconductor ecosystem. So that's the why. And now maybe we can turn into kind of just some high level background on the industry, and we can get into the value chain with a little more depth. So this is just a snapshot of the industry. The left side of the chart here is just the end markets. You know, semis are a $500 billion, give or take, industry right now. You know, this year will actually be a year of decline in revenues. We're probably a little closer to 500 billion than 575 billion. But you know, I think some of the markets that consume a lot of chips make sense. Computing, you know, smartphones are basically, you know, a lot of chips and glass stuck together with, you know, titanium these days. But then, you know, you're seeing on the left side of this chart the emergence of industrial markets, and automotive markets are also, you know, important consumers of semiconductors. And then on the right side, I mean, there's a lot of different ways to chop up kind of the different kinds of chips, but this is kind of a high level breakdown of the different kinds of semiconductors and their role they play in the industry. So logic is the biggest bucket, and we'll get to what those chips are. These are the digital chips from companies like NVIDIA or Intel or Apple. You know, analog is the cheaper chips you would buy and put into a car from, you know, Texas Instruments or Analog Devices or, you know, Infineon or NXP in Europe. And then memory is the more commodity part of the business that we'll also get to as well. This is a pretty widely circulated just end market forecast of you know, what people expect the industry to look like over the next you know, kind of through the end of the decade. This is from McKinsey. And so there's a general expectation that by 2030 the industry is going to reach about $1 trillion in revenue. And what I think is interesting is if you look at the right side of the chart and kind of the breakdown of the growth rate by the different end markets, it's broadly expected that the automotive industry and the industrial electronics industries will be the fastest growing parts of the industry over the next decade. And that is a little bit different from the last decade, where you've kind of had the rise of smartphones, the rise of the cloud, you know, and even 2 decades ago, the rise of the PC were kind of the major drivers of the industry. And now you're seeing a little bit of a handoff of growth drivers. And then the only caveat I'll add to this slide is this was released before, you know, ChatGPT and all the excitement around AI. And so I do think, you know, AI will be a more significant driver towards, you know, 2030 than is probably captured in this slide, and that most of that spending takes place in the data center. You know, the cyclicality of the industry is, you know, important to keep in mind. the industry has been cyclical forever. I think it will always be cyclical. We can get into why that is if that'd be helpful. But I think there's a few important points on why the cyclicality of the industry is less relevant now than maybe it was 20 or 30 years ago. The first thing is the industry has really matured. It's consolidated a lot. In many parts of the market, there's just a few critical suppliers. And so the companies have a lot more scale now. And so most companies can weather the cycle relatively efficiently and through high levels of profitability. And so kind of the days of the dramatic semiconductor cycles where companies would go out of business or have to raise capital at depressed valuations, I think are kind of behind us. And so this slide is from Texas Instruments, and it's a great case study because they're having a tough year this year. Their revenues are down double digits just given cyclical factors, but they're going to have a 42% EBIT margin this year in 2023 based on consensus numbers. And that's about in line with Microsoft. So even in the tough years, the biggest chip companies can be about as profitable as some of the most profitable software companies in the world. And the other thing about cyclicality, I think that's helpful to understand is chips are not a commodity. I mean, it's a growth cyclical industry, and I understand why they get compared to commodities. But when semiconductors enter a correction, these corrections are relatively short-lived because there's this trend line of electronics growth and consumption growth. So it's not like oil or materials where you could have a depressed cycle and you could have pricing, oil prices be depressed for basically an undeterminable amount of time. In semiconductors, the cycles are relatively short and you kind of know demand will snap back, and it's just a matter of when versus if. And the cycles tend to last between 4 to 6 quarters, and so you do have these ups and downs, but you're following this long-term trend line of growth, which I think is important. So now we can get into the value chain with a little more depth here, and I'll go through kind of a few major pockets of the value chain, and then we'll try to kind of put it all together. I think this will be kind of a lot of content in a short period of time, but I think hopefully we can illustrate the major factions of the industry and kind of how everything works. So going back to the kind of the breakdown of the industry, the biggest bucket of semiconductor revenue is logic. And so logic is really kind of the computational resource for any system. So if you think about kind of the phone or the chip in your iPhone, which is the Apple A17 Pro, and which is one of the most advanced semiconductors on Earth, that's a digital logic chip. So it runs your apps, like in the data center, it runs your applications, it runs your workloads. And so digital logic chips, these are the companies that generally are using kind of the more advanced manufacturing technology. Like if you hear about either the leading edge or 3 nanometer, 5 nanometer, kind of the stuff that's really bending the laws of physics, that's where these chips are being manufactured. And if you really take a step back, I mean, what chips are, what semiconductors are transistors, which are on and off switches, and then you put them onto a chip. And if you have, in these cases, billions and tens of billions of them, that's how you actually run an electronic system. It's just lots and lots of on-off switches. And so, digital companies try to put as many of these switches as possible onto one piece of silicon, or sometimes multiple pieces of silicon, and kind of put them together. And power, the key end markets for logic, as you can imagine, are smartphones, data centers, PCs. But you are starting to see more advanced processors move into areas like your car, or into a factory, into a robot. And so that's an exciting kind of trend for logic. And then there are a few different business models in the kind of the logic market. So on the bottom left of the slide here is Intel. So Intel is kind of the last, it's called the integrated device manufacturer. That's where they do the chip design and the manufacturing in-house. So Intel kind of famously still owns their own factories. And the kind of to the right of Intel there is NVIDIA and Qualcomm, some of the household names on the chip design side. So these are fabless chip companies. So all they do is design semiconductors. They have tens of thousands of engineers, and they build what they want the chip to look like in software, and then they hand that off to a manufacturing partner. So the term fab in the chip industry means fabrication plant. And so if you're fabless, that means you don't own your factories. And so that's really that business model has really come into vogue over the last 10 years, and we'll get to that. But they've just been phenomenally successful with the partnership of TSMC in terms of taking market share from Intel and from other factions. And then the other big part of the industry that I think is becoming increasingly relevant is on the bottom right of the slide here. So a lot of vertically integrated tech platforms are becoming chip designers as well. So Apple obviously designs their own chips that go into the iPhone, but Google designs their own chips for artificial intelligence. Tesla designs their own chips both for their data centers and for use in the cars themselves. And it's not just a US phenomenon. Alibaba, in China also designs their own chips for the data center. And so I would just say this interest in designing your own chips and maybe being a little bit more vertically integrated, I think is just a good example of how strategic semiconductors have become, especially over the last, kind of 5 to 10 years. So, a totally different part of the market that I mentioned is analog. And so relative to digital, where these are high-priced chips that are using the very bleeding edge of manufacturing, analog chips are actually relatively cheap and like 30 to 40 cents type cheap. And they don't use leading edge manufacturing. They use manufacturing processes that are 15 to 20 years old. So that actually results in very profitable business models. So what analog chips actually do is, the digital chips all run in zeros and ones. They're just executing computer code. But the physical world doesn't actually, operate in terms of zeros and ones. Like if you think about temperature or vibration or wireless signals, that's really a gradient. And so what you need is a chip that can interpret signals from the outside world and translate that into zeros and ones. And that's what analog chips do. And so the leaders in the analog space, I put along the bottom of the slide here, TI, Analog Devices, prominent in the US. There's some very well-established analog suppliers in Europe as well. And part of the reason I think some of these, especially the European companies, are well positioned is analog chips tend to go into the industrial and automotive end markets. You think about any sort of industrial equipment being digitized. You think about the grid needing more power management. Your car is basically becoming a smartphone on wheels, and that needs a lot of small, cheap semiconductors to help interpret video signals, LiDAR, radar, even like the sensors that detect when the rain hits your windshield to turn on the windshield wipers. All that is analog, and then that translate that signal to to the digital processor. And so kind of a high quality, analog business, I would say kind of between 2/3 and 75% of their revenue would come from the automotive and industrial end markets. And back to my kind of previous point, that's going to be an exciting area of growth, for the industry over the next, the next 10 to 15 years. Memory, I'm not going to spend a lot of time on here. So memory is the most commoditized part of the market. It's really the only part of the chip market that, still has kind of quarterly price declines and volume declines. So it really is like a pure commodity where the parts are mostly compatible. And if you wanted to swap, a piece of Samsung memory for a piece of Hynix or Micron memory, that's pretty seamless relative to other parts of the value chain. So just quickly to walk through it, there's two kinds of memory. There's DRAM and there's NAND. DRAM on the left side of the chart, NAND on the right side of the chart. DRAM is the memory that sits closer to your processor. So like in your PC, when your PC is running slowly, someone might say, you need more RAM in your PC. That's because, there's not enough storage close to the processor to execute, the applications on your PC. And then NAND on the right side of the chart is really your storage. So that's like in your phone, you've got 256 gigabytes of memory for your photos and your music and podcasts and things like that. That's NAND. It's also called flash storage. And so, what's noteworthy about the memory market, especially on the left side of this page here again, is the DRAM market has consolidated from probably dozens of players over the years down to really just 3 players, which is Micron in the US, SK Hynix, and Samsung, and both of them are in South Korea. So memory has gotten, I would say, geopolitically sensitive, which we'll get into. But especially in the NAND market, it's one of the few markets where domestic Chinese competitors really made some breakthroughs. And so that's led to a lot of scrutiny and some export controls. But generally, I just think since memory is more of a commodity, I spend less time on it, but it is still an important part of the market. One of the key constituencies in the semiconductor industry, and really the way the industry has evolved a lot over the last 10 years, is the rise of third-party manufacturing. And so we talked about the different business model types that Intel still designs their own chips and builds them internally, whereas most of the industry now, especially on the kind of digital logic side of the business, they design their own chips and they rely on someone, generally TSMC, to actually build those chips. And so TSMC is the partner that has to spend the billions of dollars on capex to build the fabs to actually meet their customers' demand. And so the scale, if you look at the right side here, TSMC is more than half of the market for kind of outsourced manufacturing of chips. And again, so TSMC is partnering with NVIDIA or Apple or Google, and they're building their chips, building the physical chips for these companies. And what's unique about TSMC and about the kind of foundry model is it really is just kind of this increasing returns game and this increasing scale game where, TSMC will spend $6 billion US in R&D this year and over $30 billion in CapEx in 2023. And so, I mean, outside of Amazon and Microsoft, I think TSMC is the biggest spender of CapEx in the world. And they've spent $200 billion on CapEx over the last 10 years. And so in terms of, someone trying to replicate TSMC and the extent that, we'll talk about geopolitics and people being uncomfortable with where chips are manufactured now, that's a lot of history and a lot of chips, a lot of manufacturing capacity that's been built that would have to be replicated if you wanted to replicate a TSMC. And then most importantly, TSMC is basically a monopoly for the most leading edge chips for the 3 nanometer, 5 nanometer chips that are in your iPhone and your PC going into the data center. TSMC is basically a monopoly in that part of the market. So they've got over 90% share. Samsung is kind of the second source to them, but Samsung, unlike TSMC, is not a pure play foundry. Like TSMC doesn't design any chips. All they do is just build chips for partners. Samsung does both. They build chips for partners, but they also still build their own chips internally. And so you kind of get a little bit of competition if you're looking to build with Samsung. Another really key enabling part of the ecosystem is semiconductor capital equipment. So there are really 5 main players here across the bottom of the screen. The big 5 are ASML in the Netherlands, KLA, Applied Materials, and Lam here in the States, and Tokyo Electron in Japan. So these 5 companies have about 2/3 of the market for semiconductor equipment spending. And so I think what's important to understand about semi-cap equipment is even though there are 5 big companies that are scaled, each of these companies really operates in their own niche. So across the very bottom of the slide here, you look at ASML, they basically have a monopoly in lithography. They're the only company in the world that provides the lithography for kind of the most advanced chips. And lithography is the step where you actually imprint the pattern of the chip onto the wafer. KLA, in the areas where they operate, in process control, which is making sure that you have no defects on the chip throughout the process, they have more than 80% market share in most of the end markets that they participate in. And even in etch and deposition, which are Applied Materials, Lam, and Tokyo Electron here, they have niches within etch and deposition where they have very dominant market share. And so, part of our thesis on semiconductors, a part of the way I've thought about it for a long time is these are companies that the world can't exist without. Like if ASML or KLA disappeared from the face of the earth for some reason, you literally can't build a semiconductor, and then all of a sudden, I think economic progress is basically set back, years. And so just in terms of the criticality of the role that these companies play in the world, I think it's very important. And then, I think you saw a handful of those companies were on the chart of, the best performing stocks in the equity over the last 10 years. Like, why is that? In terms of like the relevance of capital equipment to the industry now compared to years ago, for a long time, you actually took less equipment to make chips. So every dollar of revenue for the industry required less equipment. But basically, as kind of the Moore's law has gotten extremely complex, and we're kind of looking at atomic level scale for the last decade or so, it's actually taken more dollars of equipment spending to get every dollar of revenue growth for the industry. And so you basically saw a period of declining capital intensity for a long time, and now the industry is getting more capital intensive. And so that the implication of that is that the equipment vendors will grow more quickly than the overall semiconductor industry. And then kind of the knock-on effect of that's not captured in this chart, which is from Applied Materials, is you're also seeing geographically motivated spending that, in the US and the EU and in Japan, you're seeing governments and customers, frankly, want to bring factories back from Asia and bring them onshore. And so the industry is going to just get less efficient. So you're going to have more factories, probably not operating at 99%, capacity utilization all the time, but it'll be more geopolitically safe. And so that's another add-on effect to make the industry more capital intensive is you're going to have all this equipment that maybe isn't being used perfectly efficiently all the time. And frankly, for most of the history of the industry, it was really just globalization and being as efficient as possible. And one of the nice things about chips is they're very high value to weight ratio. Like you can fly them all over the world in 747s because they're so small. So you can build a chip in Taiwan and ship it to America for packaging and then ship it back to Asia for test or something like that if it works. And that model of kind of the globalized industry is kind of at least in question right now. And it is, if you compare that to the automotive industry, you want to build stuff close to your customers. Chips are very different because they're just so easy to ship around the world. Just to spend a few minutes on ASML and what makes them so special, and I think just kind of bring to life why why these things are so hard to replicate, and why ASML honestly has become such a sensitive company geopolitically also. So EUV stands for advanced ultraviolet light. Sorry, had a little bit of brain fog there. And so EUV is basically the next generation of lithography system that we're going to use to make the most advanced chips. And so to achieve kind of the light wavelength of light that we need to do to print these very fine features for the smallest chips, you use the EUV systems from ASML that have been shipping since kind of 2019 and 2020, at least in volume. So you have a massive laser that sits below the floor of the factory, and that laser is actually provided by Trump, which is a German company. And so they shoot that laser up through this beam transport system, and then you can see there's a droplet generator at the top of the screen. And so the droplet generator will drop into a vacuum microscopic droplets of tin, and the laser beam will hit the drop of tin in midair to create that will explode the tin and create a plasma. And so it does this 50,000 times every second. You're hitting this droplet of tin out of midair. And then from there, the plasma creates the ultraviolet radiation, and that radiation bounces through a series of mirrors. And those mirrors are made by ASML's partner Zeiss. And they're actually the most uniform surfaces ever made in the history of mankind. They're literally the flattest surfaces humans have ever conceived of, because if they weren't perfectly flat, they would absorb the light. So then that light will bounce through a series of mirrors. Then we shine through what's called a photomask, which is kind of the design of the chip, and project it onto the wafer. And so, I mean, obviously there's a lot of science here, but the point is, this took 20 years to come up with. It took partnership with TSMC and with Intel and with Samsung. There's a lot of material science, there's optics, even just there's know-how of trying to get these things to work in a factory. And it's, the idea that someone's going to be able to replicate this, I think is super unlikely. So I think that's what's made ASML such an amazing company. And so these systems cost, about 200 million euros right now. And that cost is going to go up to more like, 300 million euros over the next few years. So the last major bucket of the industry that is a key enabler is the design software. So if you're going to design a chip, you need CAD software, similar to if you want to design a car, you might use software from Dassault, or if you want to design a building, you might use software from Autodesk. So what you're trying to come up with on the left side of the slide here is a blueprint for what the chip might look like. And so that's what these companies that are EDA stands for Electronic Design Automation Software. That's what the EDA companies do. So Cadence and Synopsys have kind of the lion's share of the market. They're both US-based companies, and they provide the software to an Apple or to a NVIDIA or an AMD to actually put the chip design together. And I would just say that EDA is a $10 billion market. It's growing double digits. These companies are highly profitable. I would say it's one of the most attractive pockets of of software that we've seen as it's hit maturity, especially. So I know that was a lot. So putting that all together, this is really the foundry fabless model, where you've got the fabless chip companies that outsource their manufacturing to TSMC. This is really how it all fits together. So you start with the EDA software. If I wanted to design a chip tomorrow, that's from Cadence or Synopsys. You buy the software, you use that software to do the physical layout of what you want the chip to look like. You simulate it to make sure you're not going to have any issues with with heat or signals getting crossed or anything like that. So the chip design company, whether it be NVIDIA or AMD or one of the hyperscalers like Google, they buy the software from Cadence or Synopsys. They pay about 15% of their R&D budget or 2% of their sales for that software, and then they with their thousands of engineers lay out what they want the chip to look like. Then they pass it on to their manufacturing partner, and so TSMC will actually physically manufacture the chip for them. And what's so critical about TSMC is, like, if you look at their partners, the fabless partners, they've got no plan B. Like, if TSMC can't build the chips for them for some reason, if they had a cyber attack, if there was an earthquake in Taiwan, if there's geopolitical conflict, there's nowhere for them to go. And so they bet their future on TSMC, and that TSMC can build the chips for them, build them to the specs that they're hoping for, so that both companies can kind of get the margins they want out of them. And so it really is just a unique kind of level of partnership. It's very symbiotic in terms of the way these companies have to work together. And then so TSMC builds the factories. They're full of equipment from the semiconductor equipment providers. So the two acronyms down here, SPE and WFE, semiconductor production equipment, wafer fab equipment, you hear those a lot. So those companies supply to the companies like TSMC that are building the big factories, or Samsung for that matter. Really quick contrast with what Intel does. Intel does the design and manufacturing themselves, and what you've seen is they have to fight battles on two fronts. They have to be a better chip designer than AMD or NVIDIA or Apple, because Apple's putting their own chips in Macs now, and they have to be better at manufacturing than TSMC. And so it's really been a difficult model for Intel to kind of keep up with. And so if you look at this is the top 5 fabless companies versus Intel on the left side of the chart. So in 10 years ago, 2013, they were roughly the same size, and now the top 5 fabless companies are worth about 10 times as much as Intel. And similarly, TSMC versus Intel on the right side of the chart, TSMC's market cap was significantly lower than Intel's in 2013, and now it's multiples higher. So kind of this open ecosystem where there's more companies all working with TSMC, that really has won. And I would say if you needed one major insight in semiconductors over the last 10 years, it's that the open ecosystem is going to beat the closed ecosystem. So that's the value chain. Now to switch gears and talk about geopolitics. This is a little plug for a white paper we wrote in 2020. Basically, I think before there were chip shortages and before Chris Miller wrote the book Chip War, which is a fantastic book, I think we were one of the first kind of groups of investors to talk about just how critical these companies are to the world and how critical semiconductors are to the world. So that it's a kind of a fun read that's on our website about our investing thesis in semiconductors and why we think some of these companies that we've mentioned are so critical. So on geopolitics, just a few kind of key themes. These are all interrelated, but they are different. I think TSMC's role in manufacturing is an existential threat to governments, to their big customers. I think just there's a lot of concern around a potential geopolitical event between China and Taiwan, understandably. And frankly, I mean, there are earthquakes in Taiwan. There are other reasons why TSMC could be pulled offline, and it's given their monopoly position in manufacturing mission critical chips. And it's not just iPhone chips; it's chips that go into like fighter jets, chips that go into the intelligence apparatus for their data centers. I mean, it's kind of everything that the governments need to operate that needs chips. That's all built in Taiwan by TSMC. So that is a very top of mind concern. And I would say somewhat related is just the U.S. wants to limit China's progress in compute around AI. Like I think they don't want China to have the capability that we have to, or that the West would have to, whether it's simulating nuclear weapons or bioweapons or using AI for surveillance, which is a big problem in the PRC. That is that's something that's another kind of vector. And then frankly, the U.S. has learned that we can kind of put any company out of business using export controls. And lastly, China's made in China. There's been a big effort for a long time. There's large funds to kind of onshore more semiconductor prowess, and those have had mixed results. So there's just a few slides here, and then if we get to AI by the end, we can wrap up on that. So this is an interesting snapshot of just the way the industry has evolved over the last 40 years. This is market share of revenue by region. So the U.S. has been relatively stable. Europe has been relatively stable at a lower base. Japan was one of the leaders in the industry in the late 80s and really kind of fell off and misexecuted. And then you kind of see the rise of the Asian players. So South Korea has done very well in the memory market, like I mentioned, in DRAM and NAND with Samsung and Hynix. Taiwan has really risen to prowess with TSMC, and then China is taking share, and that the upward trajectory of their kind of progress is notable. Maybe they're not making as much progress as they hope, but it's starting at zero, so they're doing okay. And this is kind of an amazing chart. I think this is the share of manufacturing capacity over the last 30 years. So if you go back to 30 years ago, the U.S. and Europe manufactured more than 80% of the semiconductors in the world. And with globalization, like I mentioned, of the ease of chips, flying them around the globe, manufacturing has left the EU and Europe, or the EU and the US. And so now, close to 20% of chips are built between the EU and the US. And I think this chart is meant to be a little bit alarmist, but the forecast, this is from Boston Consulting Group, they have China being the leader in semiconductor manufacturing by 2030. And so that I think has set off some alarm bells in terms of the way we approach our relationship with China. This is a chart from the Semi Industry Association, which is the kind of the lobbying association here in the States. And so if you look at kind of a lot of the key enablers of semiconductors, like EDA software, the US has dominant share, the fabless design companies like NVIDIA, AMD, a lot of those are in the States. So that's the kind of the purplish, dark blue line here on the left side. And on the equipment side, which I think semi equipment is a key enabling technology, the US has about 40% share, but we've kind of struck multilateral agreements with the Netherlands and with Japan to basically make sure that we can control what China can and can't buy in terms of semiconductor equipment. So that's all kind of the background on geopolitics. I'll go through this really quickly. So, we're heavily reliant on Taiwan. I think that's very well understood. Like the CHIPS Act and other kind of policy angles to try to diversify supply chains away from Taiwan, but I think we're an order of magnitude too low in terms of the amount of spending that's being given towards the CHIPS Act if we really want to pull manufacturing out of Taiwan. And there are challenges with building factories outside of Taiwan because they've been built there forever and they know how to do it. If you come to the States, TSMC has said that just the cost of building the physical building, like not the equipment, but just the shell, which is very complicated because of all the automation and chemicals that go into it, that costs 4 to 5 times as much in the US as it does in Taiwan. There's also a shortage of skilled workers. They're flying in workers from Taiwan to help the US manufacturing efforts for the factories that TSMC is building in Arizona here. And lastly, even if you build a manufacturing here, there are other parts of the value chain like that are offshore, and no entity, no country or region is ever going to have everything onshore. There's always, whether it's packaging of the chips, testing them, you're always going to be flying them somewhere else. Raw materials, there's thousands of raw materials that goes into chips, and just one random example is neon gas is an important input for semiconductors, and it turns out that the majority of the neon gas produced in the world comes out of Russia and Ukraine, and no one really thought about that until the Russian-Ukraine conflict. And so there's a little bit of like a whack-a-mole dynamic where every time we think we have something under control, that something else that we didn't even think about is purchased from another region. And so I think the idea of bringing the entire supply chain and having a really safe supply chain on US or EU soil is next to impossible. So this is kind of a colorful quote from Chris Miller's book, Chip War, who basically, Wilbur Ross, who was in the Trump administration, basically realized we can put any company we want that buys electronics out of business because the US has this dominant share in most parts of the chip supply chain. And so we decided we wanted to put Huawei out of business. Huawei, was like a $100 billion revenue company that is kind of like the Cisco and Apple of China. They made routers and networking equipment, and they made smartphones. And the US didn't want them to be the leader in 5G. Like they were kind of seeing that the 5G backbone across the globe was being built on Huawei equipment. And so we just said, we're not going to sell chips to Huawei anymore. And we basically crippled a $100 billion kind of national champion company. So there's a lot of export controls right now. We basically aren't letting, companies in China get the computing power that you could get in other parts of the world, the equipment for building chips, and then the EDA software. So it's kind of these key choke points where the US has kind of a monopoly, and we can, do as we please in terms of enabling access to technology. So how is this going? Like, how is China doing relative to all the efforts across the globe to keep them from succeeding? I would say we're having mixed success. What tends to happen is companies know that export controls are coming, so they stockpile chips and equipment. And so, excuse me. So there's been a lot of stockpiling of GPUs from NVIDIA. There's stockpiling of semi equipment. And then they have had some breakthroughs. So, there was a Huawei phone that was released 2 months ago that has a 7 nanometer processor in it. And that's a pretty sophisticated processor. It's probably 4 years behind what you would see in the States, but I think we thought that they would be 10 years behind us, given all the export controls. And they're using pirated software to design the chips. Like there are just workarounds. And there's also just a lot of loopholes in all the export controls. And so I think what I'm hopeful for, and no one has a crystal ball on this, but that we'll kind of ease some of the restrictions and find a way to be a little bit more symbiotic, because this kind of whack-a-mole game of trying to close every loophole possible is not really working for either party. And this is just a chart from Bloomberg that's been topical. The black line is this year that the percentage of sales for each company that's going to China. These are the major chip equipment sellers. So the black line is this quarter. The blue line is the percentage of sales going to China this time last year. So there's a very significant amount of equipment being bought in China. And that's despite not being able to buy the most advanced stuff. So they're buying this to do more chips for automotive and for kind of other parts of the industry. So we've got about 2 more minutes here on my 45-minute budget. So I just want to talk about AI and NVIDIA really quickly, just because it's so unique to have, a $1 trillion market cap company in the ecosystem. So I think it's well known that NVIDIA has 90% share for the processing for training AI models. If you look at the chart here on the bottom, the left side of the chart shows to train an AI model, you basically just force feed a lot of data into a cluster of GPUs, and NVIDIA makes more than 90% of those GPUs. And then so that's called the training part of the process. And then inference is where you actually take that trained model and deploy it. So that could be, your self-driving car making a decision. It could be asking ChatGPT a question. That's the inference part of the model of the process where you take a trained model and ask it questions. So I think these are 2 really interesting charts. On the left here, this is just the computational requirements for AI models. They're moving extremely quickly. This is a log scale, so everything is an order of magnitude. And it basically just shows the demand for computing power for AI is so far completely insatiable. And maybe that will change just given the magnitude of the spending that's being seen right now. But it is just incredible what's happening. And then the chart on the right, I think is kind of funny. It's the papers published in AI, and that's also following a log scale. So it's growing exponentially. And that actually, these are academic papers published. And this actually preceded ChatGPT and all the excitement around this chart preceded ChatGPT and all the excitement around AI. And so I think if you even pull this up, if you updated this chart, it would be, the chart would be even steeper. So what does that mean? So NVIDIA has taken a dramatic amount of share in the data center. So this kind of the grayish line that's across the bottom of the chart here, that's Intel's revenue share. And so if you go back to 2015, Intel had 97% share in the data center, give or take. And now NVIDIA has 60% share, and this is also a growing pie. So they've gone from 1 or 2% share to 60% share of a growing market, and really honestly kind of crippled Intel in the process. So what does that all translate to? That this is NVIDIA's quarterly data center revenue on the top, and then there are just overall quarterly revenue for the whole company on the bottom. And so you can see kind of the very right side of the chart, you basically had an acceleration at scale I don't think you've ever seen in any company, any tech company or otherwise in history, to have a company that has tens of billions of dollars of revenue start growing kind of like doubling or tripling year over year is pretty unique. And so we can kind of argue about the sustainability of this, but it is certainly, it's just an exciting time for NVIDIA. And they have put a lot of work into the ecosystem over the last 15 years to put themselves in this position. And so despite their success, they still have kind of this monopoly market share so far. So that kind of the punchline of all this is NVIDIA actually has the highest revenue of any company in the chip industry now, which is not something I would have predicted 5 years ago, but just given their execution and given the demand for AI, that's where we are. And then one of the points I didn't make is the beauty of fabless chip manufacturing is the margins are extremely high. I mean, it really is more like a software company. Like they've got 70%, close to 70% gross margins and close to 50% operating margins. And so if you're looking at 80 to 100 billion dollars in revenue with that margin structure, it actually doesn't seem crazy that NVIDIA would be worth more than $1 trillion. So that's kind of the walkthrough of the industry from my angle. Here's my contact info, my emails on there. It's just john@nzscapital.com. Our team is active on Twitter, kind of with varying frequency, and we've got a lot on our website, as Moritz mentioned, in terms of thoughts on semiconductors and other industries. And then we have done a few other podcasts, like the top right kind of image there is a YouTube video that we did that was relatively well circulated. It just was kind of a teach-in on semiconductors and also some of the stuff we've talked about today in terms of geopolitics. So thanks so much for your time. Hopefully this was helpful. Hopefully it wasn't too much information crammed into a short period of time. It's a lot to cover, but with that, maybe we can open it up for Q&A.
Perfect, John. Thank you so much. Just as a reminder, we already received a couple of questions, but please take advantage of John being with us here for a couple of more minutes and put your question into the Q&A box. So you presented the facts and the narrative for the next question already, but maybe specifically on Europe, the whole positioning you mentioned to Trumpf lasers, ASML, but overall, how is Europe's competitive positioning in this whole market? We saw that the market share in manufacturing used to be much higher. What is it these days? What's your assessment?
Yeah, I mean, I think Europe has pockets of excellence in semiconductors. I feel like where they are well positioned, they're well positioned extremely well. Like, I mean, lithography being the kind of poster child, but also in the analog market. I mean, you've got NXP and ST Micro and Infineon that are really clear suppliers into the kind of automotive and industrial markets. So I would say that, like, if I had to do a forecast, going back to that chart that had every country's market share, every major region's market share, I would expect them to be kind of like flat market share to maybe modestly down, just given my kind of concern of what's going on in Europe, as I do worry about the kind of the automotive supply business, given the rise of Chinese automotive OEMs. And so I kind of worry that if you're kind of selling chips to the market share losers, then that could be a problem for the industry over time. And then in terms of the opportunity to bring manufacturing back at scale, I would say I'm less positive on that potential. I'm kind of less positive on that everywhere, but at least in the US, it's like really concentrated. And honestly, the big customers that want the chips in the US are there, like Apple is there, and NVIDIA is there, AMD is there in the US, and you don't really have that same pull in Europe. And so I think Europe will continue to do really well on kind of the less advanced stuff, on the analog and the technology that's a little bit older. And then I think ASML is basically insurmountable in terms of their their role in the ecosystem as well.
Perfect. And you mentioned that the whole semi value chain is getting a little more capital intensive. So that would, from a structural growth perspective, favor the capital equipment players. Do they then really benefit over the next decade with higher growth rates? Are there any other outliers that are a little bit faster than the rest of the market?
Yes. Yeah. So my general take, and if you look at the last 10 years, the industry has grown. I mean, there are cycles, but it's grown at a 10% CAGR in terms of overall equipment spend. And that I would say that the chip industry over that time probably grew 5 to 7%. And so I think you've seen that over the last 10 years. And I think it will continue and potentially be even faster, just given the geographic diversification dynamic, that the industry is going to be less efficient. So you're going to need more factories and more equipment in those factories. And then it's kind of unique with each company. I think generally the companies that have been outgrowing the industry will continue to outgrow the industry. ASML, I think, is very well positioned to outgrow the industry. They're probably the one I would highlight the most, just given they've got a very clear line of sight into their next generation of equipment. Those are going to be the EUV, the acronym I stumbled on is extreme ultraviolet systems. Those will be, they're going to be 50% more expensive in 2 years than they are now, and so they're taking share of kind of a pie, and that seems pretty bankable for the next, through the end of the decade, I would say.
Yeah, perfect. And just as an example, if you look at NVIDIA and the percentage of sales that they invest back into R&D, or at TSMC and the amount of capex they put back into the business, I mean, these are huge entry barriers for other players with which that want to enter the market. So if we want to choose one area out of this semi value chain where you want to leapfrog, would it then be maybe software where it would be easiest to enter? I mean, easy in relative terms.
Yeah, that's a good question. I think the two areas I would say is sometimes you get industry transitions that open up opportunities to kind of like leapfrog or gain share. So a really good European example is ST Micro. In some of their markets, they're transitioning to a new base material, a new substrate called silicon carbide, and so that's a special material that lets electric vehicles charge faster and have longer range. So they've done really well with Tesla in that business. And so I would say ST Micro is doing better in kind of the next generation of materials and kind of that emerging business than they were historically. And so that's a chance to kind of like leapfrog and take market share. And then I would say the other area that actually the barriers to entry are relatively low, you just need a lot of capital, is fabless chip design. So like, for Microsoft just announced that they want to make their own processors for the data center to go after NVIDIA. And basically they're spending, billions and billions of dollars on NVIDIA, and NVIDIA probably has 85% gross margins on what they're selling in the data center. And so if they have the money, Microsoft has basically unlimited R&D budget. They can get the EDA software, they can hire the engineers, they can use TSMC to build the stuff. And so I would say on like a pace of change dynamic, I would say that's fabulous. NVIDIA has the ecosystem and it's taken them a long time to build that up. So you can't just disrupt them overnight. But I would say that the range of like how everyone will be positioned at the end of the decade is probably widest there, just because on the EDA software side, since you mentioned it, it is the precision in these tools and just the way that engineers have used them their whole career is very it's very unique. And so I think never say never, but I think it's relatively unlikely that industry gets gets disrupted unless it's something by AI, and like all of a sudden the AI just builds the chips itself and we don't need people anymore, which at least for the next 10 years seems unlikely.
Got it. Here's one question. Will Intel be able to compete with TSMC in advanced chip contract manufacturing question mark?
I personally think it's unlikely. I think Pat Gelsinger has done a good job. He inherited, honestly, a struggling company, and he's doing what he can to catch them up. But I think one of the things that's unique about TSMC is just they've been doing this model for the entirety of the company, and so there's a lot that goes into being a contract manufacturer. It's making the best chips, the best transistors, the best performance and power dynamics, but it's also customer service and just making sure that you're a great partner, that you've got the capacity there. TSMC is very bold. They'll invest through a downturn. They think very long term, and they're honestly, at least for now, they've got more liquidity and kind of more capex dollars to spend than Intel does. And so I think Intel will be probably successful in other parts of the market. Like you can do kind of the less advanced chips in the automotive market or in the industrial markets, and I think Intel will have some success there. And there's a push in the States for them to be successful. But I think it's unlikely that they'll be like the iPhone will ever go from TSMC to Intel or one of kind of like the major processors kind of thing.
Okay, got it. Thank you. And then very much related to the discussion that we had before, laws of physics. Here we have one question: Moore's law and logic for chips, because we can't go much smaller. So when do we have to reinvent the wheel? What are your thoughts for the far future?
Yeah, that's a great question. I think so there are organizations that kind of put out roadmaps, and so the industry can kind of get comfortable with at least what the next 10 years looks like in terms of physics. So like IMEC in Belgium is an incredible organization that is kind of an R&D partner for the whole industry, and they'll collaborate with TSMC and with ASML to really figure out what the industry is capable of producing. And so they have a roadmap that kind of gets us through the middle of next decade. And then at that point, I think there are there are open questions. Like one of the things that different parts of the market, of the chip market, has done, like Moore's law, the chips get smaller two-dimensionally. It's like you're building a one-story house with smaller rooms. But other parts of the market, like memory, have started building vertically. And so I think that's one angle is either having more transistors that are vertical. And then there is this kind of revolution right now around, it's called advanced packaging, where instead of building like one really big chip with 100 billion transistors, maybe you build 4 chips and each has 30 billion transistors, and you kind of like stitch them together. And so I think the industry is like incredibly, the ingenuity of the industry is incredible. I think we've always only had about 10 years of visibility into Moore's law. And so I think we'll get to 2035 and see where we are. But there are, especially with the rises of AI and the computational power we have now, like I think the possibility that we have quantum computing or kind of major breakthroughs is getting more exciting just because we have all the computing power to help, research those fields, if that makes sense.
Perfect. And then maybe we can merge a couple of questions here. Why are the system providers, Apple, Google, and the likes, all moving towards designing their own chips? Isn't it a cost-saving measure, or do they try to increase the product? And another person mentioned Tesla producing their own hardware. How sustainable is this, and why do you even want to insource this business?
Yeah, so I mean, I think it's a little bit different for every company. I think Apple, when Apple kind of moved into the chip business, it honestly was very non-consensus. And I think their view was through hardware and software integration, for really being vertically integrated, they could produce the best products. And I think that honestly was right. I think compared to having an operating system that was more disjointed, and like how does an Android phone work on a Qualcomm chip versus a Samsung chip, I think Apple really got to control the whole process, soup to nuts. And I think that's why it was such a great bet for them. And I think now that they've been doing it for so long, there is margin savings there that if they were working with Qualcomm, let's say, and Apple sells 230 million smartphones a year, and Qualcomm gets a $10 gross margin on that. I mean, that is like billions of dollars of revenue. It's not massive, but it's or of margin savings that they're getting. And then I think the cloud guys, for designing their own data center chips, I think it's an imperative to make sure that that NVIDIA doesn't have a monopoly. And so like Google's been very successful with their internal AI processor. Microsoft is following them. Amazon's following them. But I think their goal is at least to have an option where in a few years, NVIDIA has much lower market share, because NVIDIA, frankly, is extracting a lot of value out of the industry. And these companies are spending tens of billions of dollars on GPUs for AI, and that maybe that's not sustainable. And then Tesla's hard to know. I mean, I do think being vertically integrated helped them. Like during the pandemic, they had more control over their own supply chain, and so they didn't have the shortages that other companies did. That was a huge market share tailwind for Tesla. And so I think Elon's view has been kind of more like Apple, to be hardware, software vertically integrated, and they tend to do most in-house, even though it maybe isn't perfectly efficient, because it kind of helps you control your own destiny a little bit.
Great. And then we have one here on merging equipment companies, Alarm KLA, 2016. Is this, how did that play out for competition in the sector?
Yeah, so basically, there was some M&A kind of early last decade in capital equipment, but Applied Materials tried to merge with Lam Research, or with Tokyo Electron, and Lam Research tried to merge with KLA, and both of those deals were blocked. So I think we've gotten to the point where, frankly, if any of these companies tried to merge, their big customers like Intel's and Samsung's kind of go to the regulators and say that this would harm competition. So I think outside of there are small tuck-in M&A deals that happen. I don't think you're going to see any of the big five have any M&A.
Yeah, that makes sense. And then here, I think we have an interesting one on the supply chain. How limited, concentrated are the upstream input materials for chip production? Could chip manufacturers be easily strangled by raw material suppliers?
Yes, I think they can. I mean, it depends on, like, neon gas is one that I mentioned. It's like a minuscule part of the overall cost of the chip. So a chip company can pay 100 times the price of what the input is, and it doesn't affect the end products. It's so small. But there are definitely, I mean, it varies by the input. Some of them are concentrated in only one or two suppliers, like slurries, and like some of the chemicals they buy from major chemical companies like Dow or DuPont. Yeah, in general, and there are, I mean, that's a concern, I would say, just geopolitically, that China has started restricting access to certain materials, and that could snowball. And so that definitely is a kind of a negative geopolitical outcome, as you kind of get retaliation, in the input supply. I mean, one thing about chemicals is, like, they're generally not that hard to produce. Like, if in terms of replicating neon gas supply versus replicating ASML lithography machines, it's easier to get the neon gas supply, but so it'd be disruptive, but you could probably figure out how to do it in a year or two, would be my guess.
Yeah, okay. And maybe as a last question for you, as a local expert, your thoughts on OpenAI and the corporate governance struggle. Who do we serve, humanity or business? What are your thoughts?
Oh, that question might be above my pay grade. No, I think I just listened to an interview. Sam Altman did an interview with the New York Times, actually right before he was ousted, so it's a very interesting timing. He does seem very thoughtful in terms of what AI can do for the world. But frankly, I don't think that he's that focused on the negative outcomes, like on the kind of the existential outcomes of AI, relative to maybe he should be. And so it's a complex issue because of the OpenAI struggle. I think the nonprofit board was actually probably doing what they were supposed to do, but they didn't do it in terms of kind of protecting humanity from how quickly AI is progressing. But they didn't do it in a very professional way. They didn't give any reasons for ousting Sam. They were kind of tangible, and on just doing it out of nowhere on a Friday without talking to Microsoft, which is their biggest partner, didn't really make sense. And so we'll see. I think it's an interesting time for technology regulation that, generally, I would say most regulatory bodies are late to regulate new technologies. Like, you're seeing that we're still trying to regulate social media, and it's been 10 years, and it's been, I would say, bad for society as a whole. And so I think being out in front of it and being a little more diplomatic about it is at least a start for OpenAI. And it's the impact of AI on society over the next 15 years is hard to think about. It could be just another nice technology transition, or it could be something that totally changes the kind of composition of society. And it's really hard to know at this point.
Yeah, absolutely. 60 minutes. John, thank you so much for your time. Very much appreciated. It was super interesting.
Yeah, thank you so much for
I hand
having
it
me. I
over
really
to you for
appreciate
some
it.
closing remarks. Thanks again.